It's like putting a humidifier and a dehumidifier in the same room. Yeah, I don't know if you know what exactly I'm talking about, but if you listen to this episode, you will very soon understand why we talked about that and what's going on. 2023 predictions are starting to come in already. Is it going to be a lot more of the same? Is it going to be a big change? I don't know. We'll find out today, though, because our guest, David Smith from David Smith Home Group, has come on today's episode to talk to us about all of the upcoming potential changes and changes that have already happened in the year 2022 and upcoming in 2023. We're talking about federal changes. We're talking about provincial changes. We're talking about all the changes, everything. This is a deep, deep episode. So strap your boots on. I hope you have time to listen and focus no matter who you are or where you are or what level you have in the real estate market. You're going to need to hear everything we talk about today. As always, I'm Alex McFadyen, your host at the YVR REMO show. And if you're loving the episode, make sure to rate us, review us, and love us on Spotify and iTunes, and send us a DM. Let us know that you care. Thanks. Enjoy the episode. What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. We started the conversation right before we had to pause. More of the same going into 2023. And everything is different at the same time.
All change and more of the same.
Everything's the same, but nothing is. This is interesting. So you laid out an unbelievable breakdown of all the potential changes that are either happening, have happened, or about to happen, or at least the most,
It's kind of like a 2-month period. Like it either happened last month or it's going to happen in the next month.
Yeah, everything that's important that's going to affect real estate either in BC or in many cases the rest of Canada, because we've got listeners all over the country. Things to think about, things to hear, and things to know, whether you're in the industry or you're just a homeowner. You want to know all these things.
Yeah, it's legislative and regulatory changes that are going to have some impact in the market. Some of them are going to have large impact and some of them are going to have small impact.
And some of them's big question marks. So I love this. So you put together this for all the listeners. We'll put a link to David's article in the actual podcast notes, so you can have a chance to go through and read this. But you put together an article, and before we get into the specifics, you had an impact rating. I love that, the impact rating: 9 out of 10, 2 out of 10, 5 out of 10, and we'll let the listeners read along and hear
what was really interesting was when I was writing this article, I did. After I'd written the article with my own impact ratings, I set out the regulatory or legislative change on my Instagram in a story. And I was like, what do you think the impact is going to be on this?
Okay.
And it was really varied. Like some people thought some of the stuff that I think isn't going to have an impact is going to have a huge impact.
Right.
And then some people thought things that I think are going to have a huge impact aren't going to matter at all.
So consumer sentiment's all over the place.
Consumer sentiment is all over the place, yeah.
One quick note, you should have made this like sweater rating.
A sweater rating. I like that.
9 out of 10 sweaters.
Merry Christmas.
I think that would have been a good. I love your sweater today, by the way.
You're welcome.
We're just chatting about it on air. So you've got 100 David Smith Christmas sweaters. You've given away 2 successfully. So
I actually gave away one last year for a $5,000 donation.
Okay. So can I ask one favor? If we get anybody that reaches out specifically, can we get one winner from the podcast? Like one winner?
100%. As long as you give a donation to New Hope Community Services.
Okay. So there's got to be a donation. So how about this? Share the podcast, tag up David Smith Homes and the podcast, us here. And David will consider giving. Yes, he will give you one.
Alex is going to make a donation is what's going to happen.
Of course. Absolutely.
We'll
get a donation. So we went all the way into this, and I know there was an intro, but David Smith, thank you for coming back on the show. Appreciate it. Second time in 1 year.
Second time in 1 year, sure.
Yep. Yeah. Last time was one of our most listened episodes in the show. We just looked at that whole Spotify Wrapped thing for the podcast. How cool is that?
It was great. I'm proud of you guys. You're doing great.
Yeah. The podcast's been a lot of fun in the last, can you believe it's been 40 years now? Almost.
I can't believe that.
It's wild. So fun to have you back and fun to have these conversations. We are going to make sure to explain these things as we understand it. And as we discussed before the podcast, there are a lot of unknowns.
So I got an email. I want to read this line. I got an email from BC REA, which is the BC Real Estate Association, one of our governing bodies. And they had just sent us an email this afternoon. And we're December 12th today?
We dated it now, but December 12th, there you go.
14th, something like that. Well, that's good. I'm wearing a Christmas sweater.
We're in the Christmas season.
It better be mid-December.
You said you're going to wear it in February. So Okay, what was the email?
And the email even says, this communication underscores the most immediate policies, some of which have already come into play and some will be coming into play in the next couple of weeks. And then they continue, what we know, what we don't know, and how you can find available resources. So even our own, overseers, authorities don't really know how many of these things are going to play out. And one of the motivating factors for me in writing this article, 2023, all change and more of the same, was to even just try and get on paper for myself and for my clients, like, what are the legislative regulatory changes, and can I even begin to try and work out, okay, this is a big lever, this is a small lever, and how is that going to influence my market predictions?
Absolutely. To your point, this isn't the first time the government has rolled out changes and then not really known all of the implications of the changes or how it's impacted, a la foreign buyer tax,
I think there was legislation passed this fall that was literally blank.
Well, I mean,
in the legislative assembly.
We're going to talk. Let's get into it here because we're going to talk about a few of these.
Well, why don't we summarize what are the changes that we're talking about? Sure. Can I give a quick rundown for everybody?
High level.
So we'll start at the federal level, where we'll begin with the Bank of Canada, which understandably I'm clearly aware aren't an extension of the federal government, but they're related, and it is going to have a federal level Canada-wide impact, right? So interest rates.
Yeah.
I think they're pretty big. I think you would agree with me. You are a mortgage broker. Also at the federal level, foreign buyer ban.
Yep.
Federal level anti-flipping tax.
Sure.
Then dropping down to a regulatory one, a potential ban on exclusive listings, and we'll get into that. Then we're going to drop into the BC-wide ones, because I know that you have listeners all over Canada, and actually globally, I think you had 32 countries listening in.
Crazy. Someone's just traveling to every single country.
Yeah, someone's just bumping around. But a good number of them are in British Columbia. So some of the British Columbian ones, rental restrictions are no more. Boom, that has happened. Age restriction options have been massively reduced with kind of a one-size-fits-all policy. And then there's going to be a home buyer rescission period. I've had to learn how to spell rescission. I get it wrong every single time. That might be a problem for me in 2023. And then a landowner transparency registry. So there's a lot of changes that have all been happening at once. And I'm trying to work out, what are the big ones? What are the small ones? What are the impact factors?
For sure.
That's our summary of where we're going.
Yeah. And some of these we'll spend more time on than others, obviously, the nature of what we think could happen. Let's get, I guess, right into it then. David, why don't you lead us off? And we'll start rattling through these, man. This is your article.
Yeah, so interest rates were the number one thing for me, and I'll cut to the chase.
Yeah.
Biggest impact factor by a country mile. Yes. I'm giving this 9 out of 10. So as you and I both know, not particularly much happened at a fundamental level from where we were when the market was absolutely ripping busy, early to mid 2022. Through till where we're at right now, where we've seen, transaction volume drop around 50% in many Canadian marketplaces. It wasn't all of a sudden there were fewer buyers, all of a sudden there were more sellers, real fundamental things like that. It was an artificial reduction, which was an expression of increased interest rates, right?
Mm-hmm. It was intentional.
It was absolutely intentional.
Mm-hmm.
So and I think if we're going to look at this, we need to be fair. The high prices were an expression of cheap money, and now the depressed prices are an expression of relatively more expensive money, right? So you have to take it both ways. You can't just toss your toys out the stroller at this point and be like, but I wanted more free cheap money. This is what happens. You can't run massively low interest rates forever, but we do need to recognize that this isn't an expression of fundamental demand or supply. So the Bank of Canada very clearly have they've pivoted. Mm-hmm. They have begun increasing interest rates with quite an aggressive time frame. We've seen some 25 basis point increases, some 50 and some 75 basis point increases, which are, significant impacts on our
full
market.
1%?
Yeah, full 1% as well, which, I remember that day. There were a few phone calls that day.
Stomach drops.
Yeah, stomach drops. That must have been a tough day for you. And that's obviously having an impact. So they're trying to obviously take a little bit of the inflationary influence out of the market. There's a couple of ways that inflation can get out of control, and it really depends. And this is actually what we talked about on our last podcast. I was raising the inflation flag. As you remember, well over a year ago, because I'm one of those people that measures inflation at the source. The reason that we're now talking about inflation is because the interest rates are primarily a response to inflation running hot, as they put it, right? It's way beyond the Bank of Canada mandate of 2%. And, you know, depending on what measurements you're using and what month it is and who you're listening to, we're looking at like around 8-ish%, somewhere in that ballpark. But for me, I tend to measure inflation at the source, meaning I'm trying to use a historical definition of what inflation is. You know, I was just back in Scotland in September. I went to a vintage bookstore because I was so exhausted with being told that inflation is just an increase in prices. Historically, inflation has been more than just an increase in prices, which is measured by the CPI, the Consumer Price Index. Inflation is an increase in prices caused by, according to a dictionary that I found in Scotland, an old dictionary.
Scottish dictionary.
I pulled out the Scottish dictionary. I literally, there was a vintage bookstore next door and to a vintage clothing store. And I said, Amanda, you go shopping for half an hour. I'm going to go find an old dictionary. So I found the old dictionary, an increase in prices. And then it continued, caused by an increase in the currency supply. We know that there's been a huge amount of currency created in the last couple of years as a response in part to the pandemic, but a significant portion of that was not pandemic spending. It was just increased spending and obviously credit being extended to people and very, very, very cheap money. So that was inevitably, and it continues. And that's actually one of my points why, unfortunately, I don't think interest rates are necessarily going to pull back fast anytime soon, because in the words of Benjamin Tal, who I quoted in the article, this was really helpful. Like, this might be getting too ethereal for people, too technical for people. So what we'll do is, I'm going to quote CIBC's Benjamin Tal, because this has been the best explanation that I've been able to find for people. He said, if you look at spending, so what the government are spending, it's rising a bit too strongly for my taste. If you have fiscal policy rising and monetary policy trying to slow the economy, it's like putting a humidifier and dehumidifier in the same room and seeing who is going to win. And then he goes back to the 1980s. If you go back to the 80s, when they won the war against inflation, it didn't happen until fiscal policy joined the battle.
So we should really clarify this, because I don't think, you know, obviously there's a lot there.
Yep.
A fiscal policy, the government.
Yep.
But believe it or not, the Bank of Canada isn't necessary. I mean, everybody has their own opinion on this, but they're not the government, so to speak. Yep. They're supposed to be an independent. Anyways, point is, they're two separate things. And I couldn't agree more with you, because you have on one side Tiff Macklem saying, okay, let's get this under control. I need to raise the rates. And he's now the bad guy. But then you've got Trudy over there giving everybody rent checks. And listen, I'm not here to say that there aren't people that haven't been hurt by this. There have been a lot of families, especially in the middle and lower end, that have been negatively impacted 100%. By what's gone on here. Yeah. But giving more money is unfortunately not the answer.
No, it's unfortunately making it worse, because by nature, these programs are inflationary, because they create more deficit spending.
Yes.
So it's not like the currency that's being spread around is coming from a tax surplus.
Yeah,
it's new currency, which is, again, as someone that measures inflation at the source, inherently inflationary, making the problem worse. So to like summarize it as much as I can and get past big words like fiscal and monetary and inflation and all that kind of thing. We have a problem where they are trying to raise interest rates to bring down inflation. Inflation, which we're experiencing as higher housing prices, higher gas prices,
higher wages,
higher grocery bills. You know, the dollar is buying less.
Spiraling.
Yeah. So they're trying to cool that by increasing interest rates, making money a little bit more expensive, slowing the economy down. But as we know from history and as we know from basic logic, unless you also slow spending, which is another inflationary measure, then raising the interest rates isn't going to help. The way that I summarized it was evidenced by the constant announcements of new spending initiatives. Fiscal policy has not yet joined the battle. As a result, these hiked interest rates have done little to cool inflation, have hindered affordability. It's not like people can afford more anymore, and have cost average Canadians hundreds of thousands of dollars in home equity. Because one of the expressions of the interest rate hikes has been people are able to qualify for smaller and smaller mortgages, and therefore prices are coming down because there's very few cash buyers in the Canadian real estate market. And you and I have both had front row seats to that.
So the interesting thing about this is there's quite a few interesting things, but because we have so much to cover, we'll have to keep it relatively straightforward. So I agree with you on all accounts. Government spending put us here. The cost of money put us here. But there's an interesting point right now that people should also know. And this is let's go back. We're clarifying why we think this will impact 2023 market, just in case everybody's...
It's a big mover. Really what we're trying to work out is how big is the lever, right?
So the one thing that we have to remember, this is what a lot of people aren't realizing, is that, so we have a qualifying rate, a stress test. The stress test is 2% above the rate you're getting. And up until December 7th, you would take a variable rate mortgage to qualify for more money. That's where it was, because fixed rates went up so much more quickly. Today, as of December 7th, that no longer is the case. Now, fixed interest rates are actually going to qualify you for more money. So there's this diminishing return in raising the rates now, because no longer is raising rates going to impact house prices, right? So house prices won't be negatively impacted anymore as long as fixed rates stay remotely close to where they are. And so the only thing that's going to hurt, obviously, is current homeowner spending, which really, at this point, what will be the returns? Because now you're just squeezing people more now than ever. And, well, again, you're losing home equity. You're losing value.
One of the challenges when you're raising interest rates to try to combat inflation is that it's a lagging indicator. So you don't actually know what impact, or the government don't know, or the BOC don't know
what the impact is.
What the impact is until months and months and months later. Well, so there's been concern about, language has been used like overshooting and that kind of thing. So it's really difficult for the BOC to make these changes.
So I listen and read a lot of economic material, and especially around this, obviously, this consideration. And most are suggesting it's probably 6 months before we actually feel the quote unquote reality of what's happening right here. Last point on that, in regards to interest rates, just quickly, the market is pricing in a quarter point again in the spring at some point, whether it's January or February, March. The market's pricing that in, and that's where the market's stopping. That's where the suggestions are that it stops. Assuming.
So for the listener, when you're saying that the market is pricing such and such in, is that where the banks are setting their fixed rates, or how
Not
is that
fixed
being
rates
set?
at all? So let's simplify this. Economic predictions. Again, the bets are being placed. Let's use that terminology.
So would that be, for example, because I'm a consumer as well, and you're in the mortgage side of things, I'm in the real estate side of things. We both understand economics relatively well. But what I'm wondering about is, when you're saying the market is pricing this in,
I think there's a few considerations.
Is it in like the media, like when an economist from a big bank comes out and says this is what we're expecting? Like, what does it look like?
Well, I mean, you can look at obviously the yields, but for the sake of our conversation, I guess you could look at it from two factors. One is the sentiment. What's the sentiment in the market? And the other is looking at the economic predictions. And unfortunately, again, I don't know that we have time to dig deep into exactly what people are. But what I would say to that point is use this one consideration when we look at it, the short-term fixed interest rates from a market perspective. Short-term fixed rates are still high fives, whereas long-term rates have dropped by, in some cases, 0.5% to 1% in the last 2 to 3 weeks, which suggests that the 1-year outlook is still probably on the high side, and the long-term outlook is down in many ways. Again, there's a lot more to it than that, but just from a conversational perspective. Last piece on rates before we move on, and you give me your sweater score. We're going sweater score here today. Is I do want to touch on, for the listener of this episode, that again, that qualification piece. The most misunderstood thing that I'm hearing is that can't qualify. Yes, it hurt your qualification, but if rates go up a little bit more, it doesn't mean you're going to qualify for less anymore.
Well, it was interesting actually. The UK, where I was recently, have already removed or reduced their stress test.
Yes.
So I've heard that that's beginning to be floated in Canada as well.
Don't think they'll change it. Funny enough, a podcast episode that the listener will probably have listened to at this point, I talk about that. But for the sake of conversation, we don't have the answer this current second.
We have lots of those, unfortunately.
So we don't know what that looks like. I would say the positive. Let's talk about the positive really quickly on rates. Chances are good that we're, if not at the peak, we're very close to the peak. So that's really good. To me, that could fuel the market next year. when people know where they stand, they're less fearful about the decisions that they make, as long as they're confident, at least have a general overview.
And with interest rates, that is a good example here, where unfortunately we were harmed because the
unknown
BOC came out and said, no, we're expecting interest rates to remain low.
Yeah.
And they literally, I won't quote verbatim because I can't, but it was along the lines of, if you're a homeowner, you can trust that interest rates are going to remain relatively low. Or if you're a business owner, then you can trust that rates are going to remain relatively low.
I don't think they used the word trust, but they did say you can expect.
You can expect. So I did say I couldn't do it verbatim, but that was certainly what was put out into the market. People did obviously take on a lot of debt, and now in some regards they're paying the price for it. So what it's going to come down to, like, essentially we're trying to work out whether or not the increases that have already been made to the interest rate are going to be able to combat inflation. That's the question. We're not going to know. It's a lagging indicator. I have suspicions, unfortunately, that unless there's a reduction in spending as well as there was in the 1980s, as Benjamin Tal was referencing, then the interest rate hikes may not be as effective as we had hoped. But I'm hoping and trusting that they will work and that inflation will begin to come closer to that 2% mandated inflation rate that the BOC are trying to deliver on.
Lots we just don't know. David, how many sweaters out of 10?
I'm giving that a 9 out of 10 on the impact factor, on the sweater factor.
On the sweater scale. So 9 out of 10 impact on the market. What happens with interest rates can impact the market pretty wildly next year. I fully think that the market will stay relatively steady throughout most of next year, and I think that's going to lead to positivity in the market and more action. So let's move on. We spent a lot of time on that one for good reason.
Yep.
We've got a lot to get through, and so we're going to have to blast through some of these. We'll do it based on the sweater scale. Lower sweater scale.
Sweater scale. This next one is a relatively low sweater scale or impact factor, but it's one of the ones that general real estate consumers who were on my Instagram story thought was going to have a far higher impact. So it's the foreign buyer ban. I'm calling it a storm in a teacup.
Okay.
We're used to saying the word tax after foreign buyer. For good reason. Like when we were chatting about this before, I think you almost stumbled into saying foreign buyer tax because we're used to that. This is one of the reasons why I think this is a little bit of a storm in a teacup. Turning that into a 2-year ban when we already in British Columbia had a foreign buyer tax and a speculation and vacancy tax. I don't think it's going to have that big an impact. For someone that has seen hundreds of contracts, we actually have a box on our contract to purchase and sale, which is the offer contract, where someone has to disclose whether or not they're a non-resident for income tax purposes. So that would be someone that's not a permanent resident or not a Canadian citizen. I have seen those boxes initialed as a non-resident. Out of hundreds of transactions, I could count it on one hand. Now, that's not all of our marketplaces. Like if you're downtown Vancouver or West Vancouver or Whistler, then sure, maybe you're seeing that a little bit more. But in the vast majority of marketplaces, this is not going to have much of an impact because there simply weren't that many properties being sold to people who weren't PRs or citizens. And the other reason why it's low on the sweater scale is there are exemptions. And there's a long list of exemptions.
Oh, and so that's just it. Again, why it's a big unknown for me is quite simply, what are the exemptions? What does that look like over what time? I actually do have a client right now where this will impact. So to be clear, obviously in markets where there are more foreign buyers or more immigrants to the country, you're going to see this a lot more. 2 white guys from Langley, you might not see it as much as perhaps.
Here's a counterpoint to it though. If it was going to have a much larger impact, we would have seen an influx in transaction volume this month.
Good point. I think a lot of people just don't know about it, to be honest with you. But I would agree with that statement. However, again, we might not see them all in our neck of the woods, so to speak. But I'm working with someone right now that's impacted by this, and they're in a rush to get the contract in place. To me, it could go one of two ways. It could be just a big old stamp saying I did something from the federal government, right? Or, well, I think this could be the case as well. It'll basically cordon up a whole bunch of potential foreign buyers, and then in 2 years we could see things kind of open up quite a bit. I think there's a lot of fraud that's going to come too, which is just the nature of, unfortunately, the market when you limit.
And they're trying to combat that with other measures as well. But for me, a little bit of a nothing burger.
Mortgage fraud. Unfortunately, they try to combat it with CBC articles and so forth. Yet I hear about it all the time. Thank goodness no one I know, but it's sad.
So this is actually one of the reasons why I think the public as a whole thought that this was going to have a much bigger impact.
Yeah.
This is one of the things that I hear real estate prices blamed on a lot.
Foreign buyers, yeah.
Foreign buyers. I'm an immigrant, right?
Yeah.
Like when I purchased my home, I was a permanent resident, and now I'm a citizen. I think Canada needs to continue welcoming immigrants.
And we are. Just not the right way.
And we are. So I just don't think it's going to be a big deal.
It's not in my opinion, it's not a good use of taxpayer time or money.
Nice headlines though. Very nice headline.
Yeah. Sounds good. 2 out of 10 sweater scale?
Yeah, 2 out of 10. And we've got another 2 out of 10 coming up next.
Okay.
An anti-flipping tax.
This has been talked about for years. So let's rip through this one.
So this is just another layer of complexity as far as I'm concerned. It's very similar. Like, it sounds good in the headlines. It makes them look like they're doing something. But again, there are so many exemptions to this, because if you think about this in reality, so what they're trying to do is kind of stomp out short-term flips in real estate. So like within a year. The problem is, let me read to you the exemptions, right? There will, however, be many exemptions to the taxes, including life events like the death of the individual or related party, an addition to the household, breakdown of a relationship, a threat to personal safety, serious illness or disability, work relocation or termination, insolvency or destruction, or expropriation of the home. Like, there are so many potential exemptions there that, again, I don't see this tax coming into play particularly often, especially in a downtrending market or even a flat market. Like, this makes a lot more sense if things are going vertical and you can make, an additional 20% on your investment within 12 months.
Yep.
Plus, this was already being taxed either as business income or as capital gains tax. So again, we already had additional taxes in place. Inputting an additional tax or a ban is not going to make a big difference.
Well, I mean, what they're going for is the folks that were basically riding high on 2021.
Yeah.
Bought a property, went up in value, 200 grand. Okay, let's cash in. A lot of that happening. And people were just buying it for that purpose. It's not even the people that are flipping it and fixing it and so forth, because a lot of those folks are flipping it, fixing it, and then renting it or something like that. What I saw, and I did see this, you saw this as well, was people, buying a house. 3 months later, it went up 100 grand, 150 grand, 200 grand. Oh, let's buy another one right now. Let's buy another one right now, and let's sell that one right away. And there was a lot of that happening. Again, in an exceptionally high market, you'll see this happening. You're just basically taxing the guy who's going in there and renovating it now at this point.
As this is a complex tax one, and it was more complex before, we were having to advise people, okay, talk to your CPA, talk to your professional accountant. But our clients were getting different advice. Like, well, CRA are going to look at your intent. Like, have you held it for 6 months, 1 year, 2 years? And it was like a lot less stable. At least now we know it's 12 months, 1 year. And these are the exemptions.
It's just clear.
Again, nothing murder.
I think you're right. The same. I mean, I've seen articles posted about people who bought and sold and bought and sold, bought and sold. It is clear flipping, and they didn't pay the tax. Pay the tax. It's an investment. Simple as that. How many sweaters?
2 sweaters.
Okay, move on.
Ban on exclusive listings. So this is not legislative from government. This one is potentially from the industry. So this was a change that was floated by CREA, the Canadian Real Estate Association. It is very Ontario-centric. I know that you have a few Ontario listeners listings. So I will get into it a little bit, but I'll go relatively quickly. So basically, the Canadian Real Estate Association proposed this change to take effect on January 1st. The change that they were suggesting is, if you plan on marketing a property on the multiple listing service, which is kind of our national database of real estate properties, which is owned by CREA, and every realtor in Canada is a member of CREA. They're the ones that own the trademark for realtor, and realtor.ca. If the plan was to market it on the multiple listing service, then you had 3 days to get it on there. You couldn't have it as an exclusive listing for weeks on end. Now, that didn't come into play particularly often in British Columbia, because we're not allowed to do limited dual agency where you're able to represent both a buyer and a seller in an agency.
I was going to say, let's break that down for all the non-real estate folks.
I'm doing it right now. In Ontario, you can, as a realtor, a listing agent, have an exclusive listing. So it's not on the multiple listing service, but you are marketing that property yourself to try to pick up a buyer so that you can sell the property and represent in an agency relationship both the seller and the buyer. And therefore, not have to pay a cooperating fee. I don't want to suggest that every exclusive listing, that's the reason for that. My last sale was on Friday, a couple of days ago, and it was an exclusive listing. Now, I wasn't able to represent both the buyer and the seller, but there are reasons for exclusive listings. So that caused a lot of realtors to freak out in Canada. They made their voices heard to CREA, and it's now going to go and be voted on in April, whether or not that is a change that we want to see happen as a membership. If you're in Ontario, this may have a much bigger impact. If you're in British Columbia, I don't think it's going to have much of an impact at all. I'm giving it like a sweater scale impact factor rating of 1 out of 10.
Love it. Sweater scale 1 out of 10. One sweater. That's it. Okay, let's get into some juicy stuff because
those are the Canada-wide ones. Now we're getting into British Columbia.
so we get a lot of BC listeners, obviously the nature of where we're located here, and I mean, we are the YVR REMO show, so we typically talk about Vancouver-related events in many ways. But I mean, it's good to kind of broaden things up. So this is BC, this is Vancouver, this is what's happening in surrounding areas and so forth. And so this one in particular, I really just want to open up and talk about this briefly because this one came around exceptionally quickly, November, if I can recall.
Yeah.
As soon as David Eby came into power, more or less said we're going to make a change, and he did it. He made a change really quickly. The rental restrictions and the age restrictions, and I mean. The thing about these rules, and we're going to talk on them independently, but they're going to end up mixing together pretty quickly, is that I think intent is positive. I think there's a ton of value in both. The biggest consideration from my perspective is that, again, the sentiment from the government around these is that they're going to make some massive wholesale change. And in my opinion, I think, and maybe I should say more of this on closing, I think the reality is they're probably more short-term changes and a whole lot of confusion. And let's get into it then. So
a lot of confusion, but again, some positive headlines.
Yes, it's all about the headlines.
A lot of it is about the headlines, unfortunately, because they're trying to convince people that they are doing things for affordability.
Yep.
But unfortunately, what happens, the more you have intervention in marketplaces, the more, unfortunately, it benefits some people and penalizes others.
Yeah.
So, I mean, the first example of what we're talking about here is rental restrictions are no more, and that's referencing long-term rentals. It's not referencing short-term rentals.
Yeah.
We should make that clear for people because I know that you'll have people reach out to you looking for like an Airbnb or a VRBO or something like that. I have people reach out for the same reason. This isn't changing that legislation. That's a separate legislation. What this is changing here is if you had purchased a property with no rentals allowed or rentals allowed with restrictions according to the strata bylaws, those bylaws are no longer enforceable anymore. So trying to work out how that's going to impact the market is really, really difficult because it's going to depend very much on someone's situation. So a couple of scenarios that I ran through. Well, let's say you are a real estate investor, and I know you deal with a lot of investors, right? They previously were limited to primarily rentals allowed buildings. Maybe there were a few rentals allowed with restrictions. And for the listener, a restriction would be like a maximum number of people that were able to rent, like number of units, or a maximum percentage of units. That was where investors, for the most part, were limited to rentals allowed or rentals allowed with restrictions. So they would pay a premium for those buildings, often for those complexes, often, right? Now that investors aren't necessarily being channeled into a limited number of potential complexes for them to put that equity in. Is that going to pull back prices on those buildings where previously there was more investor demand, and now that investor demand has been dispersed across every complex? I think disproportionately it will hurt those buildings. Now, this is what I'm talking about. When you have people kind of playing with the levers, unfortunately, some people win and some people lose. So that's one potential scenario that expresses that reality. Former no rentals allowed stratas, particularly older, cheaper complexes, they might see increased demand, right? Because previously they weren't open for potential investment. Now they're open, and all of a sudden the investors that are going away from those nice, shiny, new rentals allowed buildings, maybe they can afford slightly less. Maybe they're going through challenges in their own financial life and they have less to invest than they did previously. They're going to go for an older, cheaper building and they're going to rent that out. Now, that could also potentially have ramifications because sometimes people will purchase in a no rentals allowed property for a reason. They may have had bad experiences with tenants in the past, and I'm certainly not saying that all tenants are bad. Don't hear me wrong.
Oh boy, oh boy, oh boy. Here we go, all over Twitter.
There are some buildings that I've been in which are rentals allowed, like period, or historically were rentals allowed, period. And it's almost all investors that own them.
Yep.
And the pride of ownership can occasionally suffer in those kinds of complexes.
It's and to be clear, like it's not a bad thing to be a renter.
No, of course not.
I have amazing tenants in my properties that take exceptional care of my units.
And I've rented for more time in the last 15 years than I've owned.
That being said, there is proof that as a general rule, a homeowner is more likely to spend the time and the energy to fix something that is theirs inherently. But they also have a right; they have to, right?
Yeah.
Like they have to.
So if you're one of those people in an older, cheaper building that is now going to swing disproportionately more towards being investment properties, that may be a potential negative impact for someone as well. You can also see sometimes investors, particularly if interest rates are climbing and their payments are climbing, that kind of thing, maybe they don't want to spend quite so much on ongoing maintenance on the building, which can delay potential investment in the exterior and systems of the home. So
I think what's happened too is that people think about these things in the extremes, where it's not in the extreme situation. It's just like less.
This is part of the problem, is that we're trying to work out how is this going to impact the market as a whole when these are all relatively extreme examples. One final one on that one. I had a number of clients in the past who, for whatever reason, no longer were able to live in their unit. And they wanted to rent that unit out rather than sell. And they applied for hardship. There was one that ended up in the Vancouver Sun, and we were able to get a win for that client, but it was incredibly hard. Well, now my client would have been able to hold on to that home because they wouldn't have needed a hardship exemption. So again, all these things unfortunately make predictability of the market a little bit more challenging when you're having wholesale changes just decreed from the top down.
I mean, I think the general consumer sentiment is, oh my God, or gosh, depending on your beliefs here, the reality is now we're going to have hundreds of thousands of landlord scumbag, whatever you want to call it, scumbag landlords buying all these properties and renting them out to scumbag people, and that's just not the case.
No.
It's, again, the extremes are what most people think of, probably because that's what the media reports is the extreme of every circumstance. There's just, in my opinion, I think what you said is key, is there's a lot of wins, but there are some losses. Like back to your point.
And that is what I'm trying to work out. How do those balance out in the coming months?
Again, I think and this is looking at it from an investor mindset, at least as of right this moment, you can find some great value right now in the marketplace. I really do. I think, back to your point about property valuation, I don't think the property value market will catch up quickly, even if it is rentals allowed, because the market is suppressed right now. And I think that's an exceptional potential opportunity, particularly in areas and locations where there were a lot of these rental restrictions, a la White Rock, in Abbotsford in some areas.
And it does potentially offer up some cash flow opportunities for real estate investors, which ultimately is going to be better for potential tenants because it's hopefully going to increase inventory.
Lower priced properties.
Exactly.
With great rent in good areas and more opportunity to improve. So sweat equity will be a big part of this. So,
and best case scenario for a potential tenant there is, if you get a large enough increase in inventory, potentially, that's a little bit of a cap on how high rentals are going to go. So overall, I'm actually giving this one a 6 out of 10.
6 sweaters.
I think this one is a relatively big impact. We just don't know exactly how it's going to play out.
I think the biggest thing on that, because we're talking about 2023, is that this will take years to play out, assuming it stays the same, because it's not like all these people are randomly just going to go and sell their buildings that were rental restricted. A lot of these people live there, right? So they're not just going to go start selling those things. In fact, they probably will end up just keeping them. So we'll see what that looks like. It'll be interesting.
It'll keep more money in British Columbia as well, potentially, because we did see investors, fleeing to Alberta. I know you worked with a number of them. So that's a good thing overall as well.
All right, let's get on to, so that's a 6 out of 10.
This one's super similar.
So again, of a lot of maybes, but I think it's a little bit less complex in some ways, maybe not in all ways, but nonetheless straightforward. Age restriction options. The British Columbia government came out and said, okay, there's no such thing as age restrictions anymore. Oh, wait, there is such thing. With one exemption, you can be 55 plus. So of course, as we know, there's 19 plus, 45 plus, which are the most common. I've seen 30 plus as well. I mean, there's no real rule on that. It's just a matter of what it is. Taking that away will be exceptionally interesting. I know you'll talk about like the fact that people can vote on the ages and so forth, but I'm more interested more than anything else in this one and curious.
It's been the one that's had the fastest response. Like literally today.
Why do you think that is? Most of these people have a lot of time on their hands.
They do. Literally today, I received an email with minutes from a special general meeting in a complex locally here that I sold a couple of weeks ago, where they've already responded. It was a 45 plus build or complex. Now it's a 55 plus complex. It happened immediately. So to just clarify for people, Alex touched on it really quickly. Historically, prior to this change, there were a number of different age restrictions that were finding their way into bylaws across British Columbia. Some of them would be 19 plus, some of them would be 30 plus, some of them would be 45 plus, some 55 plus. Rarely would it go over that. Now, obviously, that potentially puts someone at a disadvantage. You could even have like a 19 plus building, but then that person gets pregnant or partner gets pregnant and all of a sudden they're going to have children. What do the bylaws say? Oh, you have a year to sell, you have 2 years to sell. Like there were all kinds of cases like that. And many of these cases would find their way to court. Now, my understanding is that one of the reasons that 55 plus is the one exemption to this no age restrictions bylaws allowed is that 55 plus is one of the few ones that's actually held up in court. In fact, I believe it's the only one that's held up in court previously. So the government's not going to want to challenge that. And I think they would have a lot of very angry people who have chosen to live in an adult-oriented community. So 55 plus is still allowed. Similar to the last one on the rental restrictions side of things. The challenge is going to be that this, again, disproportionately helps some people and hurts others. So who does it hurt? Let's pick on someone that purchased in a 19 plus building, right? They're in their mid 20s. They thought, you know, I'm going to live here until I decide I'm going to have children or move out of the area or whatever it is in like 5-10 years, something like that. Well, their strata may well have already called a special general meeting, tabled, okay, we can't be 19 plus anymore, but we still want to be adult oriented. We're going to go to 55 plus. Now, that person in their mid-20s is most likely going to be grandfathered. The problem is going to come when they go to sell, because they purchased it as a 19 plus with a much larger potential buyer pool compared to now it's 55 plus and that's a much smaller buyer pool. As someone that's sold age restricted buildings and units within buildings, it is significantly harder to find a buyer for that, which is going to put downward pressure on your prices. And of course, the inverse is true as well. You could have a complex who had age restrictions and now instead of going 55 plus, they're just saying, you know what? All our age restrictions are over. We're not going to be an age restricted complex anymore. And that may see an increase in their value as well. So again, this is part of the problem with central planning in general is it's going to disproportionately impact some people positively and some people negatively. Impact factor, I think overall is going to be about 4 out of 10. I think this is going to open up potentially a little bit of inventory for people, but not. I think the majority of complexes, at least if they're 45 plus, are just going to bump to the 55 plus. That's my expectation, and I'm seeing it already in the market.
The 45 plus makes sense, and there aren't nearly as many 19 plus that I've seen out there, at least. And so to your point, if that's the case, then chances are there will just not be that much in the pool. And again, it circles back to that same conversation. The reality is it's not like these guys are all of a sudden going to go sell their properties because it went up in value by $10,000 overnight, right? The market's not going to react like that quickly.
I do think though, like in some cases, this will be a bigger difference to people's equity and potential future sale price than $10,000. I know because I will sell in the same market an age-restricted condo to a non-age restricted condo, and the difference can be, you know, comfortably $50,000. So that isn't an insignificant amount of money. And I think, unfortunately, predictability, dependability, stability of the market is something that we should be aiming for.
Well, they like to make changes, so they're going to make
4 out of 10 on the sweater scale impact factor.
4 sweaters out of 10. All right. So the last two, we've left the last two, and we'll do a sum up because I think the summary is going to be pretty solid. So homebuyer rescission period. Okay, we've been hearing about this now for 18 years. No, I mean, like, listen, like this has been talked about since 2020, 21, some kind of like period to protect homeowners. And I like the idea to a degree, I like the idea in general of protecting like the consumer. Like, I think that's great. I think it just comes down
the buyers in this case.
Yeah, the buyer in many cases, but you have to be conscious of the seller.
Yep.
And where they're at, there has to be something in the middle. And I don't know. I just find this to be incredibly confusing. And it's probably going to have a whole bunch of fun little things, but I don't know if it'll actually move the needle anyway whatsoever.
I don't think it'll move the needle particularly now. So this is, again, probably years too late.
Oh, no doubt about that. Yeah, maybe in 2020.
Because let me explain really quickly what this change is.
Yeah,
so the home buyer rescission period is an expression in the resale market of what's actually already present in the pre-sale market. So developers are under the Real Estate Developers Marketing Act. It's a different legislation, and it has baked into it a 7-day rescission period.
Yep.
Where a buyer, for whatever reason, can choose to walk away, not to proceed with the sale. Now that makes sense in that context because you're not generally going to get to take care of your subjects during that time frame anyway, right? Like your financing, well, it's probably beyond what you can get an unconditional approval for anyway. A home inspection can't take place because the property's not being built yet.
Yeah.
Titles yet to be transferred. There's so many things that you're not able to do, but they're still giving you an out there. In that context, I can understand that. In the resale market, what's changing here is there's a 3 business day home buyer rescission period being added, carte blanche to every single contract, and there's no exemptions from it. The buyer can't release themselves, the seller can't release them. And if you choose to walk away following or during those 3 business days, which in reality could be up to 6 days, depending on when the contracts are signed and holidays and weekends and everything else. You can choose to walk away not based upon standard subjects like getting your financing, your home inspection, reviewing the title, property disclosure statement, insurance, strata documents, septic inspection, feasibility, whatever it is, right? Like you can choose not to blame one of those subjects, but just to walk away.
Mm-hmm.
But there is a condition or a caveat where there would be essentially like a fine or a levy there of 0.25% of the total purchase price that would be paid by the buyer to the seller. Do I anticipate that that's going to be paid particularly often? Absolutely not, because in almost every single contract that we're seeing these days, they're not subject-free contracts anymore. You have a standard often, not always, but often, and the vast majority of the time you would have 7 days for standard subjects or 10 days or 2 weeks or whatever it is. So the likelihood of this actually coming into play for people is relatively low. Again, this is one of these legislations that's got a lot of unknowns about it. I'm a broker owner and we won't be asked by the government to take those deposits to be held in trust. So, you know, is the seller going to go after the buyer? Yeah. We've been told that we're not to have anything to do with that. I can tell you from my experience in real estate, if my sellers heard the answer, like, oh, well, Dave, remember the 0.25%, like that's going to be ours now because the buyers decided to walk away. They're not going to accept me saying, yeah, no, I'm actually not supposed to have anything to do with that. My sellers, they're going to be like, what? So I don't really know how that's going to play out either, but I think the likelihood of this having an impact at all is, again, like 2 out of 10. It makes for nice headlines. A lot of people seem enthusiastic about it. I've seen the comments on Facebook posts. I've seen the people on my own Instagram stories rating it like 4 or 5 out of 10. In the real world, I do not think this is going to make a difference unless we see another really hot market with sales ratios at like 75, 80, 100%, where there's temptation to writing subject-free offers again.
I mean, I don't even know much more I say. I agree with you. I think it's more about headlines. Again, circle back.
What it is, unfortunately, is I called it immediately provincial paternalism. Like, I don't need the government to be my daddy and tell me, hey, I'm reserving for you 3 days to just change your mind.
But I think the challenge is that the people spoke and they were loud enough to say we need a change.
Yeah.
And this is the change they come up with. And in the industry, we can see right away that the impact is probably minimal at best, but people are happy because they made a change.
Yeah.
And perhaps, there'll be, maybe they'll be happy afterwards. Maybe the change will be positive. Maybe there will be less of that. Maybe just
I will say this is going to be a lot of contractual change. Like we've already walked through this with our agents. This is going to increase the complexity again. And unfortunately, again, when you have more central planning, it leads to more complexity, more bureaucracy, and inevitably to more cost.
What's interesting about that is exactly to that point is this can actually hurt the consumer in a couple ways. Now, I'm not going to say it hurts some of the ways that they're thinking of it. The interesting thing is most people say, well, not most people, sorry. Some people say, people online say, because, they have a lot to say on Twitter and otherwise, that, hey, who needs a representative? Who needs a real estate agent? Who needs support? Who needs a lawyer for that matter? And this to me says you need a really good lawyer and you need someone who corresponds with a lawyer really well, just like all the rules in our mortgage world that come in. It's one more reason that real estate professionals, which include...
One of the reasons why I wrote this on Saturday was so that I could advise my clients well, so that I'm aware of all the legislative changes.
You understand it, you can educate on it.
The cream is going to rise to the top in this market because it is getting more and more and more complex.
Good news is, yes, you're right. The part-timers in the industry will probably have to make a decision to go all in and educate themselves, the time and the energy. And that's not to beat up anybody who's struggling in this business and perhaps not there yet. But it's people that don't take it seriously that I'm talking about. So someone who doesn't take this industry as a serious craft may struggle because they'll need to understand this or get in hot water. And now more than ever, that level of experience and education will be exceptionally important. So if you're in that position, if you are that part-time or whatever, and you're trying to get that level of support and education.
For the consumer, though, I'm giving it like a 2 out of 10 on the impact
as a consumer, you're just going to be confused about another line of the contract, and you're hoping that you have someone that can really articulate that to you and have a good friggin' lawyer, right?
All I'm going to be saying to people is there's a 0.25% fine associated with this, and they're going to be like, are we going to get that if they walk away? And I'm going to have to say 99.9% of the time no, because they're going to tell you we didn't qualify for financing.
There you go.
Not if they're working with you, of course.
Well, of course not. Of course not.
Final one, really quick. I'm giving this one, I'll just say it off the bat. Sweater scale impact factor, 1 out of 10, and it is the Landowner Transparency Registry. This was announced back in 2021 as a anti-money laundering.
Tony's been talking about this for a while, hey? Tony's bags?
Yeah. But November 30th, 2022 was the deadline for people that hold properties in trusts, in corporations, to disclose essentially who the owners of those vehicles are. I don't think this is going to change particularly much. Obviously, it increases transparency. It gives the public government more knowledge of private citizens and their corporations and everything else. Hopefully, it will reduce money laundering, but quite frankly, our FinTrack requirements, our anti-money laundering requirements, were already quite high as it is. So we'll see if it makes a difference, but for day-to-day, it's not going to reduce demand. It's not going to increase supply. It's not going to have a fundamental difference. It's a 1 out of 10 for me.
Agreed. There will be an impact, but if the impact is, the question of the conversation is, does it impact the day-to-day market prices?
I don't think so.
Undoubtedly, no. So there was a lot to cover there. No doubt we've covered everything from high level.
You sound tired.
Economics. I am exhausted from this. Like, I'm actually exhausted.
It's a lot of change. This is why I'm trying to get my head around it and help our clients get their heads around it, because it sounds like a lot. Yeah. Like I even end like saying, if your head is spinning, you're not the only one.
Yeah. And this didn't even cover every single one of the federal guidelines that we and some of these federal guidelines that came in are positively, are positive for the consumer. The new TFSA, these different types of things, but like this is just a snippet of the changes that are coming in. I love the sweater scale. And for anybody listening, well, obviously you're listening to the podcast. For everyone listening to the podcast, you have to take a minute to go pop on YouTube and check out David's sweater or the Instagram account at the YVR REMO show, or just like go look at David's Instagram account. It'll be tagged in there and check this out, because I mean, that's the sad part about a podcast is we can't see you in the glory until we see that. Yeah.
I do want to finish up though, because I do think it's important. Like when I was talking to some of the agents at the brokerage recently, a number of people are feeling almost like we're just receiving this, like it's coming from the top down and there's nothing that we can do about it. I would remind everybody, like, you can talk to your MP, you can talk to your MLA. I've talked to both my MP and MLA in the last year, and they've been very receptive. They've wanted to hear from me as a Canadian citizen. this isn't necessarily the best path for us, at least in my opinion, moving forward, to have a lot of this top-down legislation landing, trying to constantly pull levers, because unfortunately, the more market interference that you have, the more levers you have to pull, and the smarter you have to become, the more bureaucracy increases, the more inflation increases as a result of that, the more potential disproportional impacts to people happens as well.
It's like having to be an accountant to understand your taxes.
It's just, yeah, it's completely out of control. I think we need to probably advocate for a return to just, you know, basic free market principles, and that would be the best to benefit everybody.
And so there's a lot of things I can say. I won't say right now, but I will try to play this a little bit vanilla at this point right now and suggest that I agree. I do think government intervention will continue to pose unique challenges. The one thing I will provide the listener, investor, buyer, agent, whoever you are, wherever you are, is that in the market that most of us are listening, which is the Greater Vancouver area, and of course there's many others, but primarily in that region, you have one thing that continues to push the value, and that one thing is that level of supply and that level.
That's why I was talking about fundamentals at the beginning. Like all of this is artificial.
So until they fix that, sure, we'll see market values depressed for a period of time. It won't be forever, but it will eventually come back. At when and how much is always the question. But I'll leave it with this. If you have the ability to buy real estate, you know, in the next little bit here, I'd suggest if you're in a good position cash-wise, you consider doing so. I strongly believe that. But those are my thoughts and my thoughts only. And that's it. This is not financial advice. Thank you, David, for coming on the show today. Appreciate it, man. Second time around, we'll see. If you like this episode, let us know. Let David know. Reach out. Send us a reply. Share the show.
It was a deep one, but we're trying to help people understand the changes.
You got it.